Have you ever thought about how something as simple as a signature can change your entire financial future? The world of debt isn't just about numbers on a page. It's about choices that shape our lives, our stress levels, and sometimes even our relationships. Today, we're exploring what you need to understand before borrowing money, whether it's for education, a home, or just making it through a tough month. Because what most people don't realize is that debt isn't just something you take on. It's something that can take over if you don't understand what you're really signing up for. And with nearly 80% of people carrying some form of debt, this is something that affects almost all of us. Section 1. The hidden mechanics of debt. The numbers behind the numbers. Interest rates seem simple, just a percentage, right? But that number is just the beginning of a much more complex story. When you borrow $10,000 at 5% interest, you're not just paying back $10,500. The reality gets much more complicated. Compound interest is like that house guest who shows up with one suitcase, but somehow multiplies their belongings until they've taken over your entire spare room. Every day you don't pay, your debt is in there doing financial push-ups, getting stronger. To put this in perspective, when you make only minimum payments on a credit card with an 18% interest rate, a $1,000 purchase could end up costing you over $2,000 and take more than 7 years to pay off. That's not just math. That's time out of your life you'll never get back. The minimum payment mirage is particularly dangerous. Credit card companies set these intentionally low, usually just 2 to 3% of your balance, to maximize how much interest you'll pay over time. If you only make minimum payments on a $5,000 balance with 18% interest, you'll end up paying over $6,000 in interest alone and be in debt for more than 18 years. The different faces of debt. Not all debt works the same way. It's important to understand the specific type of debt instrument you're dealing with. Secured debt means you've put something valuable on the line, like your home or car. If you can't pay, they can take that item away. This collateral reduces the lender's risk, which usually means lower interest rates for you. Mortgages and auto loans are classic examples. Unsecured debt, like most credit cards or personal loans, doesn't have collateral but usually comes with higher interest rates because the lender is taking a bigger risk on you. The only thing securing their loan is your promise to pay it back. Have you ever noticed how banks have the most magnificent buildings in town? That's not a coincidence. Those marble columns are basically trophies paid for by all the fine print nobody reads. They make getting pre-approved sound like you've won something special. Congratulations! You've been selected to give us money for the next 30 years. Pre-approval pitfalls are everywhere. That exciting, "you're pre-approved" letter often contains terms that can change dramatically once you actually apply. And buried in the fine print might be clauses about variable rates, balloon payments, or prepayment penalties that could cost you thousands. Your personal debt ceiling. Here's something they rarely teach in school. Now, before taking on any debt, you need to know your debt-to-income ratio. How much of your monthly income is already promised to debts? Lenders typically don't want this ratio to exceed 43%, but to keep your financial stress low, aim for 25 to 30% or less. The borrowing sweet spot is a critical concept. It's not what the bank approves you for. It's what allows you to sleep peacefully at night while still making progress toward your financial goals. I once had a friend who made good money but couldn't figure out why he always felt broke. Turns out, almost 65% of his income was going to various debts. Car payment, student loans, credit cards. On paper, he was doing well, but in reality, he couldn't even afford a dinner out without more debt. Having an emergency fund is actually an essential form of debt insurance. Without a financial cushion of at least 3 to 6 months of expenses, even minor emergencies like car repairs or medical bills can force you into high-interest debt, creating a cycle that's hard to escape. Section 2. The psychology of borrowing. The emotional debt trap. Have you ever bought something expensive when you were feeling down? That's because spending and debt have deep psychological roots. Retail therapy, that momentary high from buying something new, can create a dangerous feedback loop. You spend to feel better, then feel worse about the debt, so you spend again to boost your mood. Many people get trapped in this debt spending cycle without even realizing it. What's fascinating is how our brains process debt. When we use credit cards, the pain center in our brain doesn't activate the same way it does when we use cash. It literally doesn't feel like real money. That's why people spend an average of 12 to 18% more when using plastic instead of cash. This is the cashless spending paradox. The less physical the money feels, the more freely we tend to spend it. The anchoring bias also affects our perception of debt. When a car salesperson starts negotiating from $50,000, suddenly $42,000 feels like a deal, even if the car is only worth $35,000. Our brains anchor to that first number, skewing our perception of value and often leading us deeper into debt. The social side of debt. Debt carries shame. People hide their financial struggles even from those closest to them. This isolation makes everything worse. Problems grow in the dark, and solutions require bringing them into the light. Social media is basically financial fiction dressed up as documentary. Everyone's living their best. Hashtag blessed life on tropical beaches while their credit cards are backstage having panic attacks. Here's me enjoying this $500 dinner that I'll be paying for until approximately the next presidential election. Now that would be an honest caption. Did you know that your attitude toward debt might be influenced by when and where you grew up? People who lived through the Great Depression often developed a lifelong aversion to borrowing. Meanwhile, those who came of age during economic booms might see debt as just another financial tool. Religious beliefs can also play a surprising role in debt behavior. Some traditions have strong teachings against interest-bearing loans, while others emphasize different aspects of financial stewardship. These deep-seated beliefs can influence financial decisions in ways we don't always consciously recognize. Generational and societal patterns. There are significant disparities in who has access to affordable debt. Studies show clear racial and gender gaps in lending. For instance, women and people of color often receive higher interest rates for the exact same credit scores as white male borrowers. Student loans represent a particular kind of generational debt trap. The average graduate now leaves school with over $30,000 in student debt. While education is valuable, many young people don't fully understand how these loans will affect their lives for decades to come. Payday lending often exploits the most financially vulnerable populations, with interest rates that can reach the equivalent of 400% APR. What starts as a $300 emergency loan can balloon into thousands of dollars of debt that's nearly impossible to escape. Understanding these psychological and social dimensions of debt doesn't just make you a better borrower. It helps you recognize when external factors might be pushing you toward financial decisions that aren't actually in your best interest. Section 3. Strategic debt management. Getting out from under. When you're deep in debt, looking at those numbers can feel like staring up at Mount Everest from the base. But there are proven strategies to tackle even the most intimidating debt mountains. You've probably heard of the snowball method, where you pay off your smallest debts first for psychological wins. Then there's the avalanche method, targeting highest interest debts first, which saves you the most money mathematically. I know someone who used the snowball method. She said after paying off her first credit card, she did a victory dance so enthusiastic her neighbor called to ask if she'd won the lottery. No, she told them, even better, I just deleted one of my financial regrets. Her neighbor was confused, but her bank account was thrilled. The debt-to-income ratio we talked about earlier isn't just important when taking on debt. It's also a key metric to track as you pay it off. Every percentage point you reduce gives you more financial breathing room and resilience against life's unexpected challenges. The tools in your toolbox. Debt consolidation is the financial equivalent of stuffing everything under your bed before company comes over. Sure, your room looks cleaner at first glance, but that lump is still there, and eventually someone's going to trip over it. You haven't actually gotten rid of anything. You've just rearranged your mess into one convenient location. That said, consolidation can be useful if it genuinely lowers your interest rate and you've addressed the spending issues that created the debt in the first place. Just be honest with yourself about whether you're solving the problem or just reshuffling it. Here's something not enough people know. You can actually negotiate with creditors. Many will reduce interest rates if you call and explain your situation, especially if you've been a good customer. They'd rather get something than nothing if you're truly struggling. Balance transfers can help too, moving high interest debt to a new card with a low promotional rate. But read the fine print. Those offers often come with fees and rates that skyrocket after the promotional period. I've seen people get stung with retroactive interest when they didn't pay off the entire balance before the promotion ended. Beyond traditional thinking, the world of debt management is changing rapidly. New AI-driven tools can now analyze your spending patterns and suggest personalized debt repayment strategies. Some apps even round up your purchases and put the spare change toward debt payment automatically, making progress even when you're not thinking about it. For some people, skill bartering networks offer a way to get needed services without going into debt. Need accounting help? Maybe you can exchange your graphic design skills instead of pulling out a credit card. These alternative economies are growing, especially in communities hit hard by economic challenges. The envelope system might sound old-fashioned, but it's making a comeback. Digital versions of this cash management technique help people visualize their spending limits and avoid the "it doesn't feel like real money" trap we discussed earlier. Sometimes the most effective solutions combine old wisdom with new technology. And don't underestimate the power of side hustles specifically targeted at debt repayment. The gig economy has made it easier than ever to bring in extra income that can accelerate your debt payoff timeline dramatically. The key is being intentional. Random extra payments help, but a strategic approach transforms your financial future. Section 4. Life beyond the balance sheet. The hidden costs of debt. Debt isn't just about money. Studies show that financial stress, particularly from debt, can literally make you sick. It's associated with higher blood pressure, poor sleep quality, and even weakened immune function. Your health is a hidden cost rarely factored into loan calculations. Chronic stress from overwhelming debt can lead to anxiety, depression, and other serious mental health challenges. And because healthcare in America is expensive, these conditions can create more financial strain, perpetuating a dangerous cycle. Debt shapes relationships too. Money disagreements remain one of the top predictors of divorce, and debt brings those tensions to the surface. Being open about finances before making major commitments isn't just smart. It's an act of love that can preserve relationships through difficult times. Future-proofing your finances. The world is changing in ways that affect debt in surprising ways. Climate change is creating new financial threats. From insurance costs in flood-prone areas to property values in regions facing water scarcity. Some forward-thinking lenders are already factoring these risks into their long-term loan decisions. Meanwhile, technologies like cryptocurrency are emerging as potential hedges against traditional debt risks, though they come with volatility risks of their own. Understanding these emerging trends can help you make more informed borrowing decisions. Let me share something few people consider. Debt doesn't just affect your current life, it shapes your future options. Every dollar in student loan payments is a dollar not going into retirement savings. With compound interest working in your favor there, the true cost of debt extends decades beyond the final payment. This creates what some experts call a retirement time bomb. Many people focus so much on paying down debt in their working years that they neglect retirement savings, only to find themselves financially vulnerable in their later years when they can no longer work. The amortization schedule, how your loan payments are structured, also matters more than most people realize. In the early years of a mortgage, you might be paying 80% interest and only 20% principal. This front-loading means that if you sell or refinance too soon, you've paid thousands in interest while building very little equity. Understanding how debt affects everything from your health to your retirement isn't about creating fear, it's about making fully informed choices with your eyes wide open. Conclusion and call to action. As we reach the end of our journey through the world of debt, remember that debt itself isn't inherently good or bad, it's a tool. Like fire, it can warm your home or burn it down. The difference lies in your understanding and how you use it. We've explored how interest really works beyond the simple percentages, the different types of debt and their hidden costs, how to calculate what you can truly afford, and the psychological and emotional factors that influence borrowing. We've looked at strategies for getting out of debt and considered the bigger picture of how debt affects your entire life. The financial system is complex by design, not by accident. but now you have some of the knowledge you need to navigate it more confidently and make borrowing decisions that align with your true goals and values. So I want to leave you with a question. How might your relationship with money change if you approached every potential debt not just as a financial decision, but as a choice about the kind of life you want to live? I'd love to hear your thoughts in the comments. What was your biggest takeaway? Has this changed how you think about any debts you're considering? In our next video, we'll dive into the truth about work-life balance, what it really means, why it's so hard to achieve, and how you can start reclaiming your time. Make sure you're subscribed so you don't miss it. Until next time, remember that the best investment you can make is in your own financial education.